Hi everyone. Be careful with these guys to my right. So they're kind of tricky. They create all these tax credits that can help you to save some money on taxes, but it can help you to pay more money in taxes if you're not if you're not careful. So you need to be careful. There are two types of tax credits. So refundable and non-refundable. So the refundable tax credits are very few. The HST is one example. Why is it refundable? Because the government pays it to you. So that's the reason why. But the non-refundable tax credit is you need to have tax payable. If you don't have any tax payable, they don't do anything for you. So it's important to have tax payable, or they do because you may earn little money and you're not going to have tax payable because of the basic personal exemption, which is in year 2022, $14,398. If you earn up to $14,398 in 2022, you will pay no federal tax. Depending on the province where you live, you will pay a little bit of provincial tax. You will pay, of course, EI premiums, employment insurance. You will pay Canada Pension Plan premiums on unemployment income, but you're not going to pay any federal tax up to that amount. So after that amount, you're going to start paying income taxes. In year 2023, this amount will increase to 15,000, and from then on, it will be increased to inflation every year. But this is something that we all qualify for it, no matter your age, no matter anything. But what happens when we turn age 65? Then other tax credits come into the picture. So, for example, the pension credit. And the pension credit is something that most people do not take advantage of it, but it's important. Here's how it works. Pension credit is only for eligible pensions, eligible pension money. Canada Pension Plan, if you receive CPP, not eligible. Old Age Security, not eligible. If you withdraw money from your RRSP, not eligible because RRSP is a savings plan, it's not a pension. But if you get your money from the RRSP and you convert it into a RIF and you withdraw the $2,000 from the RIF, then it is eligible because RIF is a pension. So that is the difference. Here is the planning opportunity. If you are age 65, this year, and no matter when you turn age 65, your birthday can be on December 31st. It's age 65 on on the particular year. If your birthday is December 31st, 2022, bingo, that's it. You have $2,000 of pension income, so then you will get a full credit, the full federal credit, which is uh, $300. It's 15% of the $2,000 credit that you have. Here is what you do. Let's say you want to continue working. You're age 65, and you say, I'm going to continue working until age 70, 71, when I have to convert my RRSP into a RIF. I'm forced to do it at the end of the year in which I turn 71. So what you do is you go to your financial institution and you tell them that all the money that you have in RRSPs to take $12,000, 2,000 per year times 6 years, and convert it into a RIF. And every year you go and withdraw $2,000 from that account. So what happens? So that $2,000 is not going to pay any federal tax because you get the credit. You save $300 in federal tax right there. Plus, you will save a little bit of your provincial tax depending on the province on your province of residence. So this is a good strategy because while $300 every year that you will be saving in tax times 6 years, you put in $1,800 from your RSP in taxes in your pocket, right? This is what happens at the end of the day. So that's why it's so important. Now, what happens in when you turn age 65 is that you qualify to have the age amount tax credit. So make sure, because this is a little bit more complex, make sure that if you deal with a financial advisor, your financial advisor understand how this work. And if you don't, well, make sure that you read enough because this is going to save you money. I'm going to show you how. Uh, the age amount is an amount of money is similar to the basic personal exemption that I showed you at the beginning, that 14,000 and change and 15,000 by 2023. So you just basically added to that amount. So if you have 15,000 plus this, give or take, say, call it 8,000. So well, in the first almost $23,000, you have a credit of 15%, which is a great credit. This is good money in your pocket. However, this age amount is tricky because this is depending how much income you have for the year. In 2022, you will add $7,898. But if your income is more than $39,826, then you start losing your credit. You start losing 15 cents of that $7,898 per every dollars over the 39,826. And then by the time you reach $92,000 of income, then you lost it completely. So here is another planning opportunity because say you're retired, say you're receiving your Canada pension plan, your old age security, and you're getting taking money out of you're receiving a small company pension, and you're taking money out of your RRSP, and you also have tax-free savings accounts. And let's leave it as that to just for simplicity. Here is what happens. So you will add how much money are you getting from Canada Pension Plan plus your old age security plus your employer pension, and then what you do is you subtract that amount from the 39,826, and the balance is what you can withdraw from RRSPs and get the full age credit. If you need more money than that, then you start withdrawing from your tax-free savings account, and only at that point in time. This is so important, guys. If you do this regularly and carefully, or if your financial advisor they do a good job, they will do this for you. You're going to save a ton of money in taxes after age 65. So be very, very careful with that. Because if you get the full amount, if you can get to take advantage of the full amount, only for the age amount, you will be saving $1,185 in income tax. That added to the pension credit, when you put it together, you look at almost $1,500 in your pocket every year. The actually it's not in your pocket, but it's money that you save on paying taxes, which translates the money in your pocket. You're keeping a bigger share of your pension income by doing this. So this is so important. Make sure that you discuss this with your financial advisor. Your financial advisor understand this because if it's a paid by fee financial advisor, most likely they do understand this. If it's a financial advisor that works on commissions because they sell financial products, well, then make sure that they understand this and they understand how the government pensions work. If you have doubts, you can always call me. My contact information is below the video, and I always offer half an hour of free consultation, either by phone or by Zoom meeting. But it's so important because these tax credits are money that you will keep, will not be paying to CRA, to these guys that create all these complex laws. And also, don't forget to subscribe, guys. I need your subscription. You're not going to miss any future videos. You're going to help me a lot. I will be really, really appreciated if you subscribe to the channel and give me a thumbs up. All that helps me to keep this channel alive. Other than that, thank you for watching, and I'll see you soon. I'll see you in the next video.